Good afternoon and welcome to the IQGEO Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Richard Petty, CEO. Good afternoon, sir.
Thank you very much, and good afternoon, and welcome to everyone on this conference. So I'm joined here today with Hayward Chapman, our CFO, and we've got a presentation here that caters for all comers. So some of you may be familiar with the IQGEO as a company and as a solution, others not. So we've got a presentation here that'll walk you through us as a company. It'll tell you something about our solutions, of course, a big section devoted to our financial results. And we've also got a section on market trends, market dynamics, and our go-to-market strategy. So hopefully that will be of interest to all of you. So I'll start with a very brief introduction to what we are. So IQGEO, we're a software company. We are dedicated to helping network operators build better networks. So by network operator, we mean two verticals, utilities and telecoms. So telecoms, we work primarily with broadband providers, so fiber, cable, and copper operators, so voice and data. And on the utilities network, we work with electricity, water, and gas companies. Probably the single most important message I'd want to leave with all of you regarding our solution is that we provide the world's only software solution that allows network operators to plan, build, and operate their networks in a single system. And for a number of reasons, this capability is extremely important, and we'll go into that later. Hayward, please do the next slide.
Thank you, Richard, and good afternoon to everyone. So just a little bit of background on IQGEO. We've got over 450 telco and utility customers across the world, over 100,000 users using our system. So that's an increase from last time. We've signed up an enterprise agreement with TEPCO, Tokyo Electric Power Company, which is the second largest electricity distributor in the world, taking their user count from 4,000 to over 14,000. So hence the number of users have gone up, and we've also signed other customers with large user numbers in the period as well. As of today, we've got over 300 staff and sort of contractors on our books. So we've got about 205 directly employed staff, and the balance are contractors who we use on as part of our services organisation. We're headquartered in Cambridge. However, our largest office is in Denver, in the US. Our European headquarters are in Ghent, which we acquired through the Comsoft acquisition, which we did in August of last year. And we've got smaller offices in Toronto, serves our Canadian customer base, and also in Tokyo, which serves our Japanese customer base as well. We sell through a combination of direct sales teams and through channel, and it varies really depending on geography. So in North America, it's totally direct. We've got about 52 members of the sales and marketing teams, that's sort of pre-sales, technical pre-sales, as well as account managers in the group. Of that 52, 32 are based in North America. In Europe, we sort of have a dual approach. We have a direct sales team, and we also sell through channel partners as well. So out of that EMEA region, we're serving sub-Saharan Africa, Northern Africa, as well as all of the countries in Europe, obviously with the different languages. So that's why we use channel there. And in our APAC region, we just sell through channel. So at the moment, NEC is our big channel partner in Japan, and we do have some smaller channel partners there as well. The product can be deployed in the cloud or on premise. And when I say cloud, it can be Azure or AWS, or even indeed a private cloud. And in terms of sort of the number of customers we've got deployed in AWS or Azure, it's about 120 today out of our 450, or slightly more than 450 customers in total. So in terms of our commercial model, we've got different approaches for different products. Our main go-to-market sort of offering is a subscription license model where we sell on a per seat, per module basis. So, you know, it's literally the number of users, and that can be through field users or back office users. And that's where the majority of that 100,000 plus users come from. With the arrival of Comsoft, which is an automated fiber planning tool, relatively historically that's used very few users, so we sell that on what we call a sort of a consumption basis, and that consumption is what we call a demand point. So you'll see that in our numbers, in our accounts, and a demand point is a premise or a home that the software is used for planned for. So when a customer of ours is using, rolling out fiber to a city and they're planning 2 million homes, they'll be using the software for that, and we will be selling them 2 million demand points at a certain price point per demand point. So that's where that sort of utilization-based consumption comes from. We occasionally sell perpetual licenses. We still offer that. That's predominantly in North America, and especially on the utility side of the business, because utility enterprises are not allowed to pass on certain types of expenditure to their customer base, so they still favor a perpetual license model. And with that, we get 20% maintenance and support, which goes into our recurring revenue line.
So I mentioned earlier that our unique selling point is our ability to provide a solution that allows network operators to plan, build, and operate their networks in one place. So our big idea, and really what is probably the most transformational idea we've had, has been that there was a need in the market for somebody to align themselves with the network lifecycle. So the network lifecycle are all of those activities that take any network, whether it's fiber or electricity or utilities, from the planning phase right the way through to the point at which it is a live revenue generating asset. So you can also think of it as the value chain within a network operator. And what we observed is that when companies don't have a single solution addressing their life cycle, they are forced to integrate a whole bunch of systems that really were not designed to work together. And this creates a significant number of inefficiencies. It creates data silos, it creates integration problems, it creates data problems, and it creates interrupted workflows. And all of this has come to a head in the telco market with the very large-scale transition to fiber that we're seeing around the world, which has resulted in a surge of capex entering telco markets, both public and private money. And this has resulted in a surge of activity, particularly in planning, design, and construction and fieldwork, which these older generation or these older geospatial stacks really have not been able to cope with. And telcos have been faced with very serious setbacks to their build-out plans as a direct result of the poorly integrated solutions that they have in-house. And so this issue of having a poorly integrated geospatial stack has actually become a concern for senior management, for CEOs, for board levels, and actually for investors as well. So this quite remarkable situation has resulted in IQGEO being called into a very wide range of telco operators who needed kind of emergency surgery to allow them to get on to the business of designing, building, and upgrading networks. So this has been this very significant trigger has been responsible for us landing in a number of accounts. And we've done an extremely good job in increasing the number of new logos, and now we're doing an extremely good job of expanding our presence within those logos as we move those customers from a single solution on this network lifecycle to multiple solutions on the network lifecycle, and really aiming to connect the dots. So our solution really consists of three building blocks for these customers. The first building block is providing a high availability SaaS-enabled system of record. System of record is an extremely important repository of information for these customers, whether they're on fiber or electricity, because it is the single source of truth for what is in production and what kit they have in production. And that matters because that network needs constant attention. It needs fixing when it breaks, it needs upgrading, it needs maintenance. And if you don't know what you have and where it is, all of those activities become impossible. You can be facing serious production issues resulting in blackouts and service interruptions, which of course results in losing customers. So the system of record is a foundation for the building and for the solution. The second piece that we provide is automation for individual departments. This allows them to do their work faster and with higher quality. And a very good example of the automation we provide is the acquisition we made last year of a Belgian company called Comsoft. Comsoft are the leading automated planning solution in the market for fiber operators. And they are an extremely well-known brand, and they are masters at creating a wide area network design on a completely automated basis. So what that means is they can replicate the work of thousands of individual designers, and that product can design a very large fiber network to the lowest cost. And in fact, that ability to design things to the lowest cost can result in some very substantial savings on the cost of building and deploying a network. Up to 4% savings in capex have been proven, which, you know, on very large nationwide rollouts is a very substantial advantage we provide. So so automation like Comsoft is available throughout the network in various different departments, and of course that means these teams can work more efficiently and quickly and with fewer errors. Last building block our solution provides is workflow. Workflow capabilities is extremely important in these organizations, particularly when they're going through nationwide projects for overbuilding or greenfield type work. And so workflow provides the ability for us to create or digitize processes not only within departments but across departments. And when you actually observe the data flows in these organizations, they are extremely complex. We're dealing with thousands and thousands of sort of subsets of projects a month that need to be pushed around various departments for approvals and for sign-offs and for walkouts and permitting and so on. And these workflows are enormously complex. And so the ability for our solution to provide a framework that allows all of these workflows and approval steps to be digitized and automated is a tremendous advantage, and it gives customers scalability and it gives them visibility for what they're doing. The last two things I'll say about our solution set is that we tell our markets that we are cloud first and mobile first, and this is really as a way of differentiating ourselves from our key competitors. So the key competitors in our market, which really sort of started a lot of them started in the late 90s. Their technology is not technology that you would use today. So client server type architecture involving fat clients. This technology is not ideal for a cloud-based solution. It does not sit happily in a cloud environment. It's hard to scale it up, and it's extremely hard to scale it down, and it's not very cost effective, and often it's not multi-entity. So our technology is cloud first. It was designed with the cloud in mind, which means that it scales extremely well. You can add users extremely well, so extremely easily. You can throw a lot of data at it, and it's performant, and it comes with the resiliency of cloud-based solutions. So we're cloud first. And the other very important feature for us is that we're mobile first. What that means is our mobile capabilities are baked into the product, and they are not a plug-on. Many of our competitors' solutions were designed in the era before mobiles existed. And as a result, the way they provide mobile capabilities is basically by providing a separate solution that uploads the data and pushes it out to mobile users. And this, of course, creates yet another interface and yet another point at which data can fail. So we're mobile first, and given our positioning, which is enterprise-wide, mobility is important because our average user will be mobile. If you look at where the payroll is in an organization like a telco or utilities, the vast majority of users are actually out in the field. They're mobile. They're in trucks with mobile phones and with tablets. So being mobile first is important because it delivers the right experience to the vast majority of users, and it creates a very easy to use and popular interface. Which really matters in systems like this, which only work if there's very high adoption rates across the enterprise. So mobility guarantees that adoption and makes us very sticky. The last thing I'll say about this slide is Hayward mentioned that these are, every relationship, every new customer we sign on, these are 20-year relationships. So we don't, very, very rarely do we look to sell a complete end-to-end solution. We do on occasion. But more typically, we'll start at some point here in the life cycle, and then what that allows us to do is over the course of years to continue working with those customers in the position of a trusted advisor and look to resolve whatever pain point they happen to have that year, and then continue moving. But what we do offer them is a direction and a strategy that leads them to a true digital workforce. That leads them to a paperless environment, and that leads them to a point where they can decide to turn off legacy systems and older systems and reduce their technical debt. So as a vision, it's popular not only with CTOs who are tasked with reducing costs and increasing digital efficiency, but also with the business users within the organization who benefit from much higher levels of productivity, much higher levels of cooperation, and a much greater ability to execute their business plans. Okay, Hayward, I'll hand it back to you.
Thanks, Richard. Okay, so I'm going to just take you all through some of our financial performance KPIs and results for the first half of this year, so the first 6 months. For those of you who have been on these calls before, this is a consistent set of KPIs. We've kept very much to the same format. So total revenues are up by 123% to 20.5 million for the first 6 months. And of that growth, 83% of it was organic. Obviously, the rest coming from the acquisition of Comsoft, which we made in August 2022. Half-year recurring revenues were up by 60% to £7.2 million. And despite that, our recurring revenue percentage was sort of slipped a little bit to 35%. I'll come on to the reasons for that on the next slide. I'll show a breakdown of our revenues and why other areas of the business have done particularly well. But overall, our recurring revenue was up by 60%. We were particularly pleased with the amount of new annual recurring revenue that we won. So that was up by 74% to £3.3 million compared to £1.9 million in the first half of 2022. And we were probably even more pleased with the fact that of that 3.3, 2.8 million of it was from expansion sales. So if I break that 3.3 down a little bit, £2.6 million was from the enterprise side of the business, and 0.7 million of it was from what we call well, it was previously the OSPI business. We first called it SMB, small and medium business, but we've now rebranded that as Velocity because they're just the sort of the speed at which they acquire new customers. It's the smaller end, the tier, what we call the tier 3, tier 4 end of the market. So within that 2.6 for enterprise, 2.3 million pounds of the new ARR was from expansion, and 0.3 million pounds was from landing new logos. And as Richard said earlier, we've always had this land and expand strategy, and now we're definitely in the expansion phase as well as winning new logos. And on the Velocity side of the business, of the 0.7 million pounds that they won, 0.5 million was from expansion and 0.2 million was from land. So we're really pleased about that, and that sort of, you'll see that in our net retention figure of 114%, which we foresee staying at that level, or at least for the remainder of this year and going forwards. Okay. So just in terms of our breakdown of our revenues, you can see there the recurring revenues that I've said grew by 60% to 7.2 million. Perpetual software, we've had a really good first half of the year, 1.9 million pounds. Traditionally, in sort of the period of the last 4 years, we've always seen that as being back-end weighted. But we've had a very good first half, 1.9 million pounds, and we foresee sort of a similar amount again in the second half of the year. So no less off there in perpetual software. And as I said, that comes with a 20% support and maintenance amount, which goes into our recurring revenue line. We've also seen 2.2 million pounds of demand points. So this is this consumption-based expenditure from the Comsoft business. Obviously, that wasn't present in the first half of 2022. It's generally got a very good repeatable nature to it. So we've got a list of about 80 customers on the Comsoft side, many of whom reorder demand points after the end of their initial contract. So we're seeing a steady stream of those coming through. Services, it's a similar trend to the back end of last year or the second half of last year. We've got some really big projects with the likes of AT&T and Brightspeed, and in the EMEA region with Stedin, which is a utility in the Netherlands. So our services business has really, the amount of volume we're putting through there has really increased, 109% up. The impact of that is our services are generally at a much lower margin than our recurring revenues and our software revenues and demand points. So those three, recurring revenue, perpetual and demand points, carry about a 85 to 90% gross margin. And despite that, the services, I'll come on to our gross margin, but the overall is lower, so it's dragged the overall gross margin down very slightly. Our exit annual recurring revenue has grown by 64% to 16.9 million pounds. So at the end of June, that was the annualized run rate going forwards. Obviously, we'll be looking to add to that in the second half of the year. And as I mentioned, due to the expansion nature of a lot of the customers, we've got 114% net retention. And actually, in our pipeline, the visibility we've got of our pipeline going forwards, I would say about 70 to 75% of what we can see, for the remainder of this year and into next year, is from existing logos as well. So we would expect net retention to remain really, really strong. Gross margin, as I said, the services, the high level of services dragged our gross margin down very slightly to 59% compared to the first half of 2022. If you've joined these calls before and looked at our results, you realise that we actually achieved 59% overall for the whole of FY22, and I think we're now at the bottom of that gross margin percentage trough. We think that we will get a slight recovery in the second half of the year and possibly manage about 60% gross margin averaged out over the full year. As we're doing more revenue and our gross profits growing, we're getting more operational leverage that's falling through to the bottom line. So adjusted EBITDA has shown a really healthy increase from 0.2 million in the first half of 2022 to 2.7 million pounds in the first half of 2023, and we remain very confident in our forecasts for the full year. We're really pleased with the order intake, up by 54% to 22.6 million. So I think in the whole of FY22 we achieved 22 million. So again, this is sort of a a record half for us. And that's a combination of services, perpetual licenses, whether they're delivered or not, and then any recurring revenue multiplied by the number of years over which that recurring revenue is going to happen. So, it's giving us better visibility of our sort of, P&L going forwards. New logos, still a good number at 23, although it is down from prior half years. But as we've mentioned several times, we're really into that expansion phase, and we're relying more on our expansion of our existing customers than maybe new logos, although, obviously we'll be winning new logos as we go forwards. Cash, £6.9 million at the end of the year. That's after paying 1.3 million out for the deferred consideration of the Comsoft business. We expect to pay another 1.3 million in the second half of the year. We're really pleased with that, because obviously that business it's probably beaten our expectations of how we thought it would perform. So we're very happy to pay that earn-out consideration out. And then in terms of headcount, we're continuing to invest in all areas of the business. This 194 was the figure at the 30th of June. As of today, we've got about 205 directly employed employees on the payroll. We're recruiting across sales and marketing, engineering, services, particularly in Europe, as we're getting a lot more new logos and expansion of existing logos in the EMEA region. And Richard's going to go through some of those new wins very shortly. So yeah, we're continuing to invest in all areas and pretty much in all geographies as well, as we continue to expand. Okay, I think back over to Richard, who's going to take us through some new logos.
Okay. So we've had a good number of wins in the first half, and here's a selection that I think tells a good story of what we've been doing. So I'll start with wins that have come from our latest acquisition. So we purchased Comsoft last August, and they, as a business, were headquartered in Ghent in Belgium, and we've since then made them the European headquarters for IQGEO. So that whole team has been trained on how to sell and deploy the IQGEO product, and that's resulted in some early and very encouraging success. So Deutsche Glasfaser is the number 2 fiber to the fiber provider in Germany. Very well funded and very aggressive rollout on fiber across the territory. So they were a relatively small Comsoft user, and the Comsoft team have worked with them on a solution that will be replacing a number of pieces of software internally. And they've now taken a full IQGEO deployment, acting as their system of record and their design solution. So that was a very exciting win and a substantial piece of ACV for us. Staying with the theme of Comsoft, Alta Fiber in North America, former Cincinnati Bell, also a Comsoft customer, has now taken a IQGEO solution to complement it. So it's the same. We're having the same success on both sides of the Atlantic. Telecom Egypt and Telenet are, I would say, older style Comsoft sales. So these were in the Comsoft pipeline when we acquired them. But what it shows here is that there's a very healthy business there of selling very significant amounts of demand points to that existing customer base, and that, of course, is very good news for our in-year gross margins and EBITDA. On the utility side, we've had 2 very interesting sales this year. So behind the NEC logo there is Tokyo Electric and Power, and as Hayward mentioned, they've now expanded their usage to an enterprise-wide license. So this is a trend we like to see, and that we expect to see in our larger accounts as they go from a few thousands of users to tens of thousands of users. So we're very pleased with that. Manitoba Hydro is a mid-sized electricity provider and distributor in Canada, but they've taken our newest product range, which is the adaptive grid product for IQGEO, which is designed specifically for electricity networks. So that's a great endorsement. it puts us on the road, I'd say, on the utilities market to getting our tier 1 customers. Exactly the same journey happened in telco, where we started in tier 3s and 2s and worked our way up to world famous logos like AT&T, and exactly the same thing is happening in electricity. So that's good to see. Altice is an important logo because with them we will be completing our cable functionality. In North America, there are broadly speaking 2 classes of broadband providers. One class came from fundamentally a copper network, and the other class fundamentally came from a cable network. So even if their expansions are being done and their overbuilds are being done on copper, you need to be able to handle the underlying asset. And so with Altice, we'll be building out our cable capabilities, and that will open up, I'd say, the other half of the North American broadband market, which came from cable. So it's a great win and a great sponsor for that functionality. It means we can go and attack other quite large tier 1s and tier 2s in North America. The last 2 I'll mention are US Navy and C Spire. So these are wins that are coming from our SMB division, or the as they're now called, the Velocity Group. C Spire is a regional mobile operator. So they have about 1,200 towers and network connected them all. And so they're a great example of the larger size SMB. So these are customers that, even though they're not small, they don't want the complexity of a heavy to configure system. So they're a nice example of mid-sized customer that really appreciate a system that has very high time to value and is easy to work with. So very pleased with that win. And the US Navy is another illustration of the kind of fiber users that we're picking up through our Velocity team. Quite simply, it's a single naval base, and it's the fiber connectivity within a single naval base. But I think it opens up a new market for us, which is military bases. And in North America, one has to go through very serious certifications, both for security and an IT vulnerability perspective. So that puts us in very good position to pick up more of these as time goes on. I mentioned earlier that I wanted to give you all a quick update on the dynamics in the market and how we're reacting to them. So on the 2 main markets we serve, both of them remain very resilient. There is some data here on fiber to the home penetration from last year, and you can see here, if you can read this, in our main markets of North America and Europe, we are still below 25% fiber to the home penetration, which means there's a long way to go before the markets start maturing, and this gives us confidence that there are many years of growth ahead of us for those modules specifically involved in designing and building a new network. What we have seen is interest rates affecting some decisions to invest. This isn't really affecting the larger organizations, have an ability to raise funds at very good rates, and more importantly, they have no shortage of very high yield investment cases internally in terms of which areas they upgrade first. So it's not really affecting them. On the lower end of the market and smaller end of the market, we are seeing it harder for startups and so on to raise funding to set up new networks. But in the North American market in particular, that end of the market is being supported by quite a substantial amount of federal funding in the form of various programs. So the American Reconstruction Act, BEAD programs, broadband equity programs, etc. All of this is being provided to support the rollout of fiber broadband to rural communities and poorer communities around North America. So that influx of federal money is providing a very good counterbalance to the difficulty some operators have in raising funds. So net, we continue to see strong momentum in these markets. And this is just to say that this slide is just to say that for each of our verticals, we provide a customized or appropriate solution designed for their needs. So in the telco market, we provide what's called an integrated lifecycle solution. Now, perhaps of greater interest is what's going on in the utility markets. There is a substantial amount of federal spending coming into utility markets in our main market, North America, and that's there to help improve grid resilience and also to assist the transition to carbon-free energy sources. And all of the bigger trend that we're seeing here is the increasing adoption of smart grid technology. So smart grids are ideal grids for situations where a lot of the energy is being produced by carbon neutral sources, which can be hard to predict, and therefore having a network or a grid that can be that can route electricity much more easily during the day, that can be self-healing, and just a more resilient grid. This relies on a lot more software, and there's some data here from a research company called IQGEO Group in New York, predicting the increased use of software for the deployment of smart grids. But I think the bigger picture here is really the age of the network. So in North America, there are very serious signs of end of life for transmission and distribution networks. 70% of US transmission lines are over 25 years old, and they have an expected lifespan of 30 to 40 years. So, this is so there's a very significant amount of upgrading of transmission lines that needs to happen. Another statistic I could share is the average age of transformers. So transformers are what convert high voltage electricity to the electricity we use in our households. The average age of the transformer in North America is 30 to 35 years old. So again, evidence of aging infrastructure that is really no longer fit for purpose. And we see similar patterns across Europe. On top of this, there is a very significant backlog, both in North America and in Europe, of connections to the grid. This is for prosumers, so this is consumers that produce, those of us that have solar panels on our roofs, we are prosumers. And also for electrification of transport, which in the US is a very significant driver, because electric pickup trucks and Teslas and electric fleets of vans and trucks are increasingly popular, and they are driving really quite a substantial amount of change to the way grids and networks work. So a substantial amount of modernization needs to happen, and this creates an opportunity very similar to what we've seen in telco, where basically the rate of change of network has to increase, and so we enter into large-scale design and build-out strategies and upgrade strategies, which we are positioning ourselves for. So here's the product I mentioned earlier at Manitoba Hydro, IQGEO Adaptive Grid, and this is a similar concept to the telco solution we provide, but the modules are different, and it does do different things for the electricity market. So it's it has required investment and hiring of experts to produce this, but the response to this product by the market has been very good, and we're very encouraged by the pipeline that's growing here, which I think in the years to come will come to dominate our new business sales. The last thing I'll talk about is the addressable market, and we do have a question on that relating to addressable size and how we're looking to optimize the opportunity available for us. So we sell in selected markets, North America, Europe, and selected territories in Southeast Asia. In general, I would say that markets we tend to focus on are where cost of labor is high, because your ROIs when it comes to trying to sell software work much better where your cost of labor is high. So these are the markets where we focus. So we target 17,500 companies across these markets, and we split verticals by segment. We split the market by vertical. which means telco and utility, and then by tier, which is the size of the organization. And in order to generate a value of this market, we simply multiply each individual customer in each individual tier by a potential recurring revenue figure that we think we could earn from them were they our customer. So this gives a total market value of over 2.5 billion pounds expressed as a recurring figure, of which 0.6 billion is in the telco market and 2 billion is the utilities market. So on this next slide, this shows the range of customers we sell to, which ranges from large to small and a wide variety of users. But another way to look at this slide is kind of as a pyramid, if you will. And it shows a couple of really interesting differences. First of all, how concentrated the telco market is in tiers 1 and 2. There's only about 100 players worldwide, and you compare that to close to 600 on the market. So that really reflects, I would say, the fragmentation of that end of the market in the utilities market. But it's also interesting to see how many small operators exist in the tier 4 market, how many universities and hospitals and military bases, etc., make up the telco market. It's really very fragmented at the lower end. And all of these customers have really quite different needs from the software, even if the data we're presenting and the things they're doing are quite similar. So if you project to these customers against a matrix where we measure the complexity of their requirements against the size of the customer, what we see is that customer base spread over quite a over both ends of this graph, and creating kind of a dumbbell effect, where on the lower tiers there is a requirement for very fast turnover of sales, a very simple onboarding process, easy to train up users, easy to upload data, and a very short time to value. In other words, getting up and running very quickly. Many of these users don't have large IT departments or the headcount or the patience of multi-month deployments. And on the other end of that market, we see the kind of things we're doing at Brightspeed and AT&T, which is very, very complex rollouts, very complex change within the organization, and therefore the need to customize these products quite substantially. And by customize, we mean even coding on site within them in order to adapt these products to these customers. And so the question here is how do we address two very interesting markets and the market in between, which is a mix of the two, with a single solution set. So the answer is the additions strategy that we launched earlier this year. So the idea behind the addition strategy is that with a single product, we can effectively present this product in a way that is most consumable, most appetizing for each customer site, and therefore give them the right experience. So the Insight product line is a shrink-wrapped, ready-to-use self-service package that has been designed by the OSPI team internally. And that information is very important because OSPI, when we acquired them, they had really come to dominate this end of the market in providing a shrink-wrapped, easy-to-use solution. And so they have vast experience in this market. And so we have asked them to design effectively a replacement for the OSPI product line. And they already sell it. So all new sales now are Insight out of that team. And it will provide an upgrade path for the 200 or so OSPI customers currently sitting on the older product line. But the other thing we will do with Insight is we will make this experience global. So we will be rolling out this product in Europe and Asia, and we think it's going to be ideal for our partner network, and it's going to be ideal for really quite a large number of smaller telco users and I'd say non-ISP users in those markets. And we'll continue the high level of customer acquisition we've had in the US with in the tier 3s and tier 4s. The professional edition is a step up from Insight, and it's designed to give a more customized experience without coding, but it offers an ability to configure a solution to a customer's needs. So it requires a bit more support. It requires a bit more assistance from us, but nevertheless is designed to give a very simple experience and no code experience to the tier 2s and tier 3s. The Enterprise Edition is a continuation of the product that we've been selling so successfully, particularly to the larger customers, both in telco and utilities. But here we will be enhancing it with a new set of functionality that would allow third-party partners to develop within the product. And this comes really on the back of requests we've had from some of our larger customers to allow their system integrators and strategic technology partners to work inside our product. And so the enhancements we'll be making, which will expose the APIs to them, will allow them to do that in a safe and supported way. What we expect to see is that our deployments and our rollouts will therefore go that much faster at these accounts. The other thing this edition will do for us is it will give us an opportunity to create a much broader VAR program, and one which will generate a new class of fees for us, particularly around training and certification. But more importantly, we'll create a revenue stream from third-party introductions and resale activity. This is important. Our competition have been doing this for a while, and creating an ecosystem around the product is a great way of increasing sales and creating an environment where we become the default standard, which is something we want to be. So the additional strategy is designed here to accelerate growth, to provide the right type of experience to the right type of customer, and also it will enable us to de-link or decouple the growth in professional services from the growth in software sales. We've done a very good job growing our professional services, and I'm very proud of the work the team has done there. But we don't want to be in a situation where we have to scale our services organization into perpetuity, while the new business keeps rolling in. And we need the ability to be able to sell software without having to hire a new set of headcount every time a new customer is onboarded. So this additional strategy means that our services team can be more focused. They can focus on the work that matters to us, which is the architecture work and deciding how solutions are going to work and so on, and really allow third parties to handle the type of work that is less strategic for us, such as integration work, data cleansing, and reporting, and things like this, which really matter to the customer, but it's not valuable high margin work that we need to hold on to, and therefore we think decoupling that kind of work from the software sales will result in much faster growth of revenue and also growth of margins, because it means more of our revenue will be coming from software as opposed to margins. And we think it will allow us to grow in all tiers of the market where we're seeing so much acceleration of sales.
Okay, so I'm just going to go through some more of our detailed financials. I'm going to try and answer some of the questions which I can see, because we've got sort of 11 minutes left and we've got 11 questions to get through. So I will try and move on as quickly as I can. So income statement, I've gone through the revenue, I've talked about the gross profit, the gross margin. I think operating expenses, we're starting to see that operating leverage come through. Going forwards, we're looking to maintain investment in our sales and marketing team. I think Richard's demonstrated the size of the opportunities in the markets in which we operate. So we think that's really important. We're also going to continue investing at the sort of current percentage rates in terms of spend on development as a percentage of sales, for example, which is around 14% in the development team, because again we've got a full roadmap of 12 months rolling roadmap of new product functionalities to develop, and requirements that our customers still want. So we're going to keep that investment at those levels for the foreseeable future, probably over the mid to long term as well. So just moving on the cash flow, £6.9 million at the end of the period. That included 1.3 million paid out as deferred consideration on the Comsoft business. If we hadn't had that, we'd have been about 8.2, so we'd have generated about 100k of cash in the first 6 months. So we've reached that inflection point. Obviously, profitability, we are capitalizing some R&D, but we've now reached that point where we're going to be cash generative, which is nice. Working capital, I think that sort of comes onto some of the questions and in conjunction with the balance sheet as well. Usually in the past periods we've had positive working capital, and we've probably had a little bit more tied up in debtors as we're growing. So we've seen a slight sort of flattening of that, but again, I'd expect that to come back in the second half. So just on the balance sheet here, I think the questions we've got from Julian H and Matthew, 2 from Julian and 1 from Matthew about the high levels of receivables. So the receivables have grown by 178% from 5 million to 13.9. If you think our overall revenues have grown by 124%, so we've got about a sort of a circa 50% gap to find. I think that's just down to the timing of payments, especially on the services side. So we're seeing a huge amount of increase in our services revenue. Some of our larger customers, we've got slightly longer payment terms than we would ideally like the likes of AT&T. They're very good at that. We signed that contract nearly 2 years ago, so that was our landmark customer at the time. They still are a landmark customer. But I think that we are better able as a group now to withstand that sort of commercial pressure, and we push back very hard on any requests for extended payment terms. It's sort of our standard payment terms are 30 days, and with our customers, as I hope Richard has explained, they really need our solution. As much as we need customers, they need our solution. So it's sort of it's a nice discussion to get into. I think Julian H had a question about the aged receivables. Now, we don't actually publish the aged receivables in our interim report, so I assume, Julian, you're referring to our stats at the end of the year. I think we had over 900k that was aged 90 days or over. I'm pleased to say that as of today, our year-end receivables as of today, we've only got 21,000 of that £10 million receivables balance, or £11 million receivable balance, that are still awaiting collection. So 21,000 over from 11 million is still outstanding. We haven't had to write any off, and I don't expect, well, I would hope we don't have to write off the remaining 21,000 either. So we'll obviously be trying to collect that. So I think in terms of the the balance, yes, it has grown, but it's just as we scale up and go through the sort of the increase in in trading, especially on the services side. So I hope that's answered those questions, which I think was numbers 9 and 9 and I think they're being removed. So yeah, fine. So on that note, I think that is it. Any questions? I think we can probably go to the questions now that we've got remaining to answer.
Yeah.
Richard Hayward, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Alessandro, at this point, I'll just hand over to you to run through the pre-submitted questions. Thank you.
Yes,
Very good.
Yes, of course. The first question is a statement followed by 3 parts. I'll read the statement and then I'll read each part separately just to make it easier for you. IQGEO are looking to transition Comsoft's revenue model from a primarily license-based model to more of a subscription model to help improve recurring cash flows and forecast predictability. This can have a negative revenue impact in the interim as a larger lumpy revenue license is replaced by the lower but smoother and more regular alternative. And the first question is, how far along that path have IQGEO progressed?
Okay, I'll take that one. So yes, we have started selling the ComSoft product as a subscription. In the first half of the year, out of our 3.3 million of new annual recurring revenue, I think we signed about 700,000 of ComSoft ACV, or recurring revenue. So it has started. As I mentioned earlier, the demand points are still, from the legacy contracts we've got, are still an important part of our product mix. And actually, we've seen pretty good repeatability with repeat orders from legacy customers. So we will continue to shift it more towards the recurring basis where we can. It has started, but I expect that we will, it will take us probably another year and a half to really change that mix completely to recurring.
Perfect. Thank you very much. And then the next part of the question is, have ComSoft license-based sales largely ended? And if not, what is the percentage split and what target date to reach expected license-based sales as a percentage?
So I think that's probably part of the same question. No, so ComSoft license sales haven't ended. We've done 2.2 million in the first half. I expect we will do at least that amount in the second half. If you remember from the second half of last year, we did 3.4 million pounds of ComSoft demand points or licenses. So we may do slightly more, but than 2.2 million in the second half. But we'll, again, as I've said, there's good repeatability on that. There's also the question from memory, Canada may be different to other territories. No, we don't think so. It operates, the revenue model operates in exactly the same way. So I think that's hopefully all of that question now answered.
Perfect. Thank you very much. The next question here reads as follows. Have customers requested new capabilities along the lines of SSP vision, field machine vision, machine learning for data capture to help reduce as-built update backlogs? And if so, will IQGEO be working to develop similar or better capabilities?
Yeah, so this if I didn't know better, this sounds like a plug for a competitive product, this question. But no, we see no demand for this. We think that solutions like this are overcomplicated and is what I would call technology that hasn't actually found a problem to solve yet. More importantly, we're working with partners like Google, who have really tremendous amounts of data on assets in the field and very significant processing power. And so we think that kind of problem will be addressed by people that own the data. This is how we expect our customers to solve these kind of solutions.
Perfect. The next pre-submitted question reads as follows. With the release of a segmented version of Network Manager, Electric, and in bracket Insight, Professional and Enterprise, can you throw some light on number one, anticipated total available market of each segment in terms of number of target customers? How many Insight in particular? Average size of an Insight type customer? Are there high density of Insight type customers in some geographies over others? And number two, when do you expect to see increased sales traction in Grid?
Okay, well, I'll answer the first part of that. So I think in Richard's part of the presentation, he threw up the addressable market, and there were those two triangles addressing telco and utility. So telcos we see as a sort of expression of an annual recurring revenue figure, about 600 million market size. That's split 107 tier 1 and tier 2 customers, 907 tier 3 customers, and 13,700 tier 4 customers. So that's the breakdown there. And obviously we think that Insight will serve the sort of the tier 3 and tier 4 markets. You're talking well over 14,000 customers for that product, and as Richard said, we don't want to we want to make it as easy as possible, and sort of having a shrink wrap hosted solution should make that give us a better chance of attacking that market. In terms of the utility market, I think there were 580 tier 1 and tier 2 customers. Tier 3 was 1,407 and tier 4 831 customers. And we think the total size of that market addressed as an annual recurring revenue figure is about 2 billion. So plenty to go at. And when do we expect to see the increased sales traction in Grid? Well, as Richard said, we've won and got others in the pipeline. So we're starting to get that traction we probably saw in telco probably about 2 years ago. So I think we're well en route there.
Perfect.
Anything to
Thank
add
you
to
very
that,
much.
Richard? Or
No, that's fine. Yeah, good answer.
Perfect. Just the final pre-submitted question here. Given recent business wins from GE and ESRI, what extra new revenue do you think that you'll be able to take from both going forward over the next 3 years, and how vulnerable are they?
Okay, so the revenue we think we can win from them is already baked into into our numbers. Most of these projects have quite long lead times, so 12 months for a new logo is typical for a tier 1 and 2 customer. So we have good visibility about what we're taking from each of those competitors. How vulnerable are they? These are very large companies with hundreds of millions of dollars in revenue, and very well financially supported. So in that sense, I don't believe we're any sort of existential threat to them. Nevertheless, we're doing very well. The reason we're doing well is because we've been very focused on doing just telco and just utilities, and doing that very well. A lot of our competition are generic, they're multi-market, and they don't quite have the depth of functionality that we do in the telco and utility space. So they will continue making a very good living, doing solutions for space exploration and agriculture and education and all that stuff. But our ambition is to become the market leader in telco and utilities, and I think we're well on the way to that.
Perfect. Thank you. That actually concludes the pre-submitted questions. As you can see, we've received a number of questions throughout today's presentation. So, Hayward, what I might do is if I could just hand over to you just to read the live questions where appropriate, and then Lily will pick you up at the end.
Okay, I will start with the question number 6 from Andrew M. It says, where do you see recurring revenue as a percentage of total revenue over the medium term? Depends what you define as the medium term, Andrew. I would say in 5 years, we think we'll be at least a 70% recurring revenue business, and we're as we've described in our strategy. We think services will grow, but not at the rate it's grown. We'll always have an element of perpetual licenses due to the utility markets. We may still have an element of demand points, but I think as we sell more and more on a subscription basis, that's going to go and layer up. And you've seen the growth in our recurring revenue. You've seen the growth in our new ARR. So we think over that period of time, 5 years, we can be at least 70% recurring, which as a good software company, we should be aiming for. So hopefully that's answered that. Colin C has said, any thoughts on acquisitions following the success of Comsoft? Yes, absolutely. We continue to look for companies who play in the sectors in which we operate. We're not going to buy anything. We think we'd want to be selective and choose good quality assets that can enhance our capability. Hopefully that answers that question. Colin C also says, number 8, how well protected is your IP, especially as you expand internationally? So I think you probably answered that in your strategy question, Richard, in terms of the enterprise product and how we're looking to lock down the IP there and use partners to try and help us expand and grow there. So we feel that our software is well protected at the moment. I mean, obviously legally we put a very high bar on that. We do not give away our IP under any circumstances from a legal point of view, and we look at ways of enhancing the code to protect it as well. Matthew B, question 11, how does the competition vary between the telco and electric markets?
Well, a number of ways we could say that. I think in terms of participants, they do vary. So there are companies we come up against that only do electricity or only do telco. But some of the base components, particularly those around system of record and sort of basic geospatial components, can be the same. So we see, for example, Esri in both the telco and both utility markets. We see GE in both telco and utility. So the answer is in some aspects it's the same, and in some aspects it's different. I think of greater relevance is the fact that we specialize our sales and pre-sales teams by vertical. That's very important. Each language, each vertical has its own language and its own concerns and its own ROIs, and we need to know those. And we provide very different, demonstrations and very different use cases to each of those markets. And we hire specialized people into each of those verticals. So we do not conflate the two markets. We treat them differently, and that's essential to get traction in each of those markets. If you are showing telco stuff to a utility, they won't spend any time with you, and vice versa. So we've invested in pre-sales, we've invested in sales, we've invested in product management for each of those two verticals, and the marketing we do to each vertical is different, and so on. So there's a lot of commonality in terms of some of the core products we use and so on, but there are differences, and we're mindful of those, and they're producing, those differences we make are producing good results.
Question number 12 from Ken C. Says, staff numbers and management hires have increased significantly in the last year. Do you feel that you have the right team in place now and expect this to stabilize? So in terms of the management hires, absolutely, we feel we've got the right team in place. We've recently hired a new CTO, comes from a significantly larger company background. We've got a new head of services who's based in Denver, who again was used to running an organization with thousands of services staff in it rather than hundreds. So overall, we feel we've definitely got the right management team in place. Will we continue to scale and bring additional members into the teams? Yes, we will. We're looking to continue the investment in sales, in engineering, as we move forwards and make the most of the opportunities we've got. Obviously, there will be operational gearing coming through, but we've definitely got, it's finding that balance between investment and profitability. Question 13. What's the most difficult aspect of persuading a prospective tier 1 customer to purchase your products? i.e., how do you convert more AT&Ts? Do you want to take that, Richard?
Yeah, very quickly. So the most important thing with any customer is convincing them to change. Change always involves risk for an organization, and there is always a concern that they might be trading one set of problems for another set of problems when they switch from one vendor to the next. So the way we de-risk it in the minds of the customer is by engaging in pilots during the acquisition process. So all large sales processes invariably have a pilot phase in it, and there we'll take a section of data, and we'll configure the product, and we'll show them that the product can do what we say it can do and what they want it to do. From a forecasting perspective, the piloting phase is always very good news for us, because we know the product performs extremely well in a pilot condition. It reacts very. It's easy to configure, and it always and what it winds up doing is showcasing the weaknesses of our competitor products. So by handling the customers gently and by walking them through these pilot phases, we show them that in fact they are lowering the risk to the organization. And when you combine that with then reference calls and prior experiences of other customers, we give our customers the confidence to use our product. So that works very well for us.
Richard, Hayward, thank you. And I think you've addressed all those questions you can from investors. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, Richard, could I please just ask you for a few closing comments?
Well, it's been a great presentation. Thank you for all your questions. We're looking forward to a strong second half, and hope to see you all for the full year results.
Richard Hayward, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of IQGEO Group PLC, we'd like to thank you for attending today's presentation. Good afternoon to you all.
Thank you.